going to start off by letting my esteemed panelists introduce themselves. Candice, can you go first, please?
Sure. I'm Candice Brackeen. I'm general partner at Lightship Capital, also executive director of Hillman Accelerator.
Malcolm?
My name is Malcolm Robinson. I'm the executive director of the Black Venture Capital Consortium, and I previously was a professional fund manager for 20 plus years.
Great. Well, thank you both for joining us this afternoon. We're extremely excited and honored you guys would join us. So, this is going to be an interesting panel. So far, Black Angels Miami has had both a combination of pitch nights for individual startup companies, as well as had some individual funds pitched to the Black Angels Miami, membership group. So now we're going to talk about investing in funds. And I think it's going to be really interesting to have the perspective of both Candice, who just started up a new fund, Lightship Capital, as well as Malcolm, who's been an investor in both individual startups as well as funds. So with that, maybe I'll just get started. Malcolm, first one's for you. In your opinion, what do you think are the top differences between investing in individual startup companies or an individual fund?
Okay. Well, the differences are several. First of all, in terms of frequency. So if you invest in a fund, then you should and will do due diligence on the fund, and I'll get into that in a minute. But once you've done that, then the discretion of all the future investments are being made by the fund manager themselves. On the other hand, if you're investing directly into individual investments, then presumably you should be doing due diligence on each investment that you make. So investing on individual deals overall should take more time commitment from the individual investor. So that's the first point. The second point is the type of due diligence that you're doing. So when you're diligencing a fund company, then you need to analyze the experience of the fund managers, obviously, and get comfortable with their track record and what they've accomplished. And particularly, you want to focus on how they're going to source, what is their process in terms of making a yes or no decision. And then once an investment's been made, what type of post-investment support do they provide those investee companies? So that's the due diligence that you would focus on when you're doing analysis of what's fun to take. When you're doing due diligence on individual deals, it's completely different. The only same thing is you have to, of course, due diligence on the team, just like you would on the fund management. But you're going to have to look at the competition to this company, how good of the product you think it is, how big is the market that they can expand into, how fast they're growing, how much competition, all those things. So the diligence frequency is different, as I mentioned, and the type of diligence would be different. You probably need to go a lot deeper in the individual companies than you do with a fund. And the third thing that's a difference is diversity, right? When you invest in a fund, you're buying into a diversified portfolio. Presumably that fund manager is going to make somewhere between 20, 30 on the low end, maybe up to 50, 60, 70 on the high end if it's a small fund, investments over the life of the fund. So there's a natural diversification. If you do investments yourself, even if you do 3, 4, 5 investments, you're not that diversified. And in VC investing, startup investing, diversification is a key component.
Thanks, Malcolm. That's an interesting point you mentioned at the end about returns. Candice, when you're thinking about marketing to LPs, how are you thinking about representing your returns that you can deliver for them?
For us, we start by thinking how much of an ownership percentage can we get in each individual company. So as we built the fund construction, we really thought about like how much can we capture based on our few investments that we'll make over the next 3 to 10 years. And so we're trying to capture somewhere between 10 to 12%. And we want every one of our companies to return at least half, right? So if I break that down into really standard math, to get half of the fund returned, which is, we have a $50 million fund. To get half of the fund returned, I need $25 million back to return half. So I need, at least 1-2 companies to exit at $250 million or more to capture that kind of 10%. So that's what we're thinking about when we're thinking about returns in particular. So as I'm vetting a company, I'm trying to figure out how long is it going to take them to get to that point? Do they have a potential to exit for that amount? Because I need to be able to return the fund and then return more money after.
Great, thank you for that. And I want to latch on to something you said with respect to the size of the fund. Candice, when you guys were thinking about the number you were going to put on the front of the cover, how did you think about sizing your fund?
So if I'm being completely honest, I was thinking small, right? I was trying to find an achievable number for someone who looks like me in the Midwest. And that number was $5 to $10 million originally. But as you figure out the math of a fund, you realize that doesn't work. Like those numbers, there's not only not enough money to kind of manage the fund, but it just makes it incredibly difficult to return the fund as well at a number that is that small. So working with a group of mentors as we were kind of building the fund construction and thesis, we really settled on a $20 million fund. Now, if you've seen anything in the press, you'll see that we're raising a $50 million fund. We've overshot our goal by quite a bit. So we were set at a $20 million goal, but now are at a $50 million goal.
And Malcolm, same question for you. How do you think about fund sizes? And then I want to ask a sort of a B part of that question based on what Candice just mentioned about they started off at 20, they're ending at 50. Any concerns or thought processes between when you're looking at a fund that might be, doubling in size or maybe more fundraising state?
Well, on the first part of the question, in terms of size, I think Candice alluded to one of the ends. You want to just be careful of the two tails, two sides of the continuum. You don't want it to be too small. And she alluded to it. If it's too small, when she says the economics don't work, it means that they're not going to have enough management fee to have a site, the proper size of team to do all the things that a fund needs to do, both in the due diligence process, sourcing, and also on the post-investment size. So small funds doesn't mean you don't do it, just means you have to address those issues of how are they going to properly have enough resources to do all the duties they need to do. And then on the other end, if it's too large, then you could be bumping into, is the opportunity set there? Let's just say that Candice was saying she was going to do $1 billion fund. And let's just say she was none of this is true to anybody, so I'm just making fun. But she was going to do $1 billion fund, and she was only going to invest in companies that were in the Cincinnati area. Then I would say, well, clearly there's a mismatch there of the amount of capital she's trying to raise versus the opportunity set, right? The opportunity set is the defined strategy and geographical area that he or she is going to focus on. So you want to just make sure that the size, that they can do what they want to do and not do what's called portfolio drift or strategy drift and start doing other things just because they have so much money. As it relates to the second part of your question, for her fund going from 20 million to 50 million, I don't think that's any issue because given their strategy, there's plenty of attractive investments out there. So the fact that you're 20 or 30 or 40 or 50 to me is inconsequential because it's still within that area of it's not too small and it's not too large. So my answer is that doesn't mean anything.
Okay.
If anything, it's a positive because it means they're able to raise money. So that's good.
Malcolm, if I can stay with you on this topic of fund size, you talked about the two being too small, not being able to operate. How do you think about funds scaling up? And I know you mentioned some of it about, it really depends on the opportunity set. but what sort of other things do you look for in terms of whether or not a fund is ready to scale up, right? You know, whether it's back office, whether it's the size of the team, like that. What are some of the things you look for when you see, you know, second or third time fund, and now they start at 50, now they're at 500 million, and haven't changed much?
So there's really 4 areas that you have to focus on that would dictate, hey, are they able to go from this size to that size? So I'll mention the last one first, because you brought it up, the back office. In the old days, i.e. when I started out, infrastructure and back office was a big thing, because most things were not automated, A, and B, there was not this huge there was not this big industry that was solely set up to provide back office services for small funds. Fast forward to today, and neither of those things are true. Most things are automated in terms of funding, you know, your capital calls, in terms of keeping track of who your investors are, communicating with investors, keeping track of what their capital allocation should be. All those things have been pretty much automated, like with a Carta, and or outsourced to a third party. So I know that for institutional LPs, they still go through that and they need to. But from my perspective, it's sort of a, you know, it's, sorry for anybody who used to be, but it's like being an offensive lineman. It's not something that you would actually do something for, but if they don't have it, then that means you don't do it, right? So nobody's ever going to get money because they have the best back office ever. But you want to make sure that you have all those things covered and they actually do have it covered. But from my perspective, I am indifferent to either they do it in-house or outsource. And that, like I said, could be easy outsource. So that one should not be a reason why a fund cannot scale up. So let's talk about the other ones. And I alluded to my last answer, which is the opportunity set, right? So if the opportunity set is relatively small, then they may not be able to scale up in terms of deal flow and investment opportunities. And that the corollary that goes with that is sourcing, right? You could have a large opportunity set, but if you don't have proper sourcing channels or niche strengths about how you're going to go about getting those deals, excuse me, then you may not be able to scale up. So how they're going to source, where they're going to source is very important. And then you talk about the process, right? So you source deals, we talked about that. Then the internal process of how you actually review deals, do due diligence, and come to that decision of yes or no. Usually when you have more money and you stay with the same investment strategy, i.e. you're not really writing a lot bigger checks, then obviously at some point you're going to need more staff. Now, the most important part of that are the senior people, because junior people and mid-level people can be trained, they can be reoriented. So the fact that they're going from 8 employees to 15 or 16, so it's double, that wouldn't scare me as long as the senior people have the bandwidth to make sure that they can properly train and bring on new employees, and that they have a set process and culture in place that new employees can kind of come in and do. On the other hand, if they were a smaller firm and they were still sort of figuring out their process, and the senior people were involved in every single step, and therefore it hasn't really been processed, that's a word, then I would be concerned about them going to the next level, because that's probably going to be a bottleneck. So how they have their processes, how they go about decision-making, and the bandwidth and experience of the senior people would dictate if I think they're ready to go from X amount of money to the next level. As I mentioned before, I don't view, if we're using it as an example, going from 20 million to 50 million in that category at all. I view that as the same size fund for all intents and purposes. It'd be different if you're talking about them going from 20 million to like 200 million. And then I think you have to have a deep dive. Doesn't mean they shouldn't do it. I'm just saying you'd have to have that conversation of everything I just talked about. And then the third or the fourth bucket would be post-investment support. What type of support are they providing? So if they were saying, look, we are on each and every board of every company we invest in, And now that we're running $500 million, we might have a portfolio of 100 companies where before they had 20. Okay, is that still your thesis? You're still going to be an active board member? And if that's true, then you probably need some more senior people because you don't really want to have a junior person on the board of a company. So it depends on their strategy of how much post-investment support is inherent in their strategy. Some literally say, we're not active at all, we're relatively small, we write a check, we make some introductions, and that's it. Others have a whole A to Z post-investment strategy that they believe is very important to their success. And if that's the case, as they ramp up, then are they able to provide that level of service for their investment style? So those are the things I would look at.
That's super helpful. And Candice, when you have your vision board on, whiteboard in the office and you're thinking about, okay, we're lightship 3, 4, 5, what are some of the things that stand out to you in terms of you want to see these foundational pieces on the board or achieved before you scale up the fund size?
So your question is more around what I think Lightship Fund 5 and 6 looks like?
Well, it's just sort of what are some of the pieces you think will have to be in place to get to sort of some to get that to 10x this fund size. And now you're 500 million in terms of some of those things that Malcolm may have been mentioning as well.
Yeah, I think it's going to take other great partners, right? So I think as we go through Fund 2, 3, 4, 5, it's finding those junior, senior associates that start to grow in their in their careers. We'll be able to follow them and track the way that they think, because we can't be the only ones finding and searching for companies, right? So search comes from them as well. It's not just us. And so, my goal long-term is to have more women that look like me working with me, and the same thing, on the male side. So for us, that's the goal, is to train and retain some of the people that we bring on board. So one of our first hires last year, before we even announced the fund, was a young lady that was at a $2 billion fund previously to us. So she had already been trained in the fine art of due diligence. Her investment memos are, top notch. We made sure that she went through, quite the process for interviewing to understand that this was exactly what we needed, because some of these memos were going to go to, our potential LPs. And so we've gotten her to a really good point, and, we'll hire another junior associate here in the next little while. And so I think that there's just got to be a slow and gradual ramp up for us. And then on the other side is we hired our first venture partner a few months ago, a gentleman out of Tulsa who has, really strong investment experience. And so that will be another way for us to kind of like jumpstart into consecutive funds.
That's super helpful. Going back to fund size, some of the times, at least in my experience as an LP, you might find a starting up, fund have a large backer, right? Somebody who has an outsized investment within the cover size, and sometimes they may ask for preferential terms or treatment. Candice, how do you think about that? Have you encountered that either now or in the past, in terms of, you need this money, right? But you also want to think about obviously your broader LP base as well. What's your thought process behind that?
So I'm living this in this exact moment. So this isn't broadcast like all over the place, right?
No, it's being recorded. So.
Okay, cool. So I won't say like who it is. So, we're a $50 million fund. We had a group come in and say they wanted a rather sizable allocation. So I would say almost half. And so in the beginning we said, absolutely, yes, like happy to do it. But as we've thought about it over the last few months, we've had other very well-known LPs come to us and say, okay, well, we want a $10 million spot in your fund, but then we want a $20 million spot in the next fund, right? So now suddenly we've gotten into this conversation about Fund 1 and Fund 2. And so now we're kind of reshuffling, moving around the deck chairs. and saying, okay, well, I mean, it's an incredible position to be in as a first-time fund manager. Don't get me wrong. So now we're kind of saying, okay, well, you asked for, let's say $20 million. Can we squeeze this down to 5 and have you participate in the next fund as well? And thank goodness this is a great LP and they're okay with that. It allows us to get in some large institutional investors with great subject matter expertise that can work with the companies that fit within our thesis. And so it's a semi-difficult conversation to have, but we've built a strong relationship with our LPs. And so we are constantly in conversations. And once they understand our thought process around it, they got it. And so, yeah, that's kind of how we've been managing things.
Charmel, I'll add something to that, if that's okay.
Yeah, please.
I've been on both sides of that table, and I know exactly what you're talking about. As it relates to your point about there being a sizable investor in that may have preferential terms, right? So 2 points on that. One is it's the concentration, and then there's the preferential terms. To the extent you're dealing with committed capital, i.e. private equity or venture capital, or it's a long-term commitment you draw down over time, I think the size, especially if it's a well-known LP and therefore the probability of them not honoring their capital calls is basically insignificant, then I don't see that as an issue. But if it's on a more hedge fund-like type structure where they have either daily, monthly, or quarterly, or even annual liquidity rights, then I think it could be a big issue, because then you have some gate issues and front-running issues. But you don't have that in the private equity or VC. So the mere fact of the size from the perspective of another LP, not from the perspective of the fund manager, which Candice just addressed, but from the perspective of an other LP, I don't see that as an issue in and of itself. Now, the fact that they get preferential terms, again, it depends on the situation. If they were early on and they basically validated this whole thing, and that's pretty much why everybody else is coming on, then more power to them. I don't see that as being a big issue. Second scenario where I think it's fine is where, and Candice alluded to it, maybe one of the LPs is adding strategic value in terms of subject matter, or maybe they can be a customer, or there's a whole host of ways that an LP can provide strategic value. And again, in that scenario, they should, as another LP who may not get those terms, I'm okay with that. To me, it's where somebody who's coming in late in the game, adding no value to the situation, and then they're given terms, as an LP, another LP, then I'd be like, come on, what was up with that? So I think the best way to handle it is just make sure that there's disclosure, and not necessarily disclosure of what exactly the terms were, but at least that does exist, right? So, because I think as an LP, if I'm not told that, I don't like that. If I'm coming in, we're all big people. I can handle the fact that somebody else may be providing more value than me as an LP, and therefore they're getting preferential terms. But I think I have a right to know that. I have a right to know that, yeah, okay, some other LPs came in, and it's up to the fund manager to say what amount of detail they want. A lot of times it's in a side letter, and a side letter is confidential, and I get that, and therefore I don't have the right to see it. But I have a right to know that they exist. In my opinion. And when I was in Canada's chair, that's what we did. We had a lot of investors, and some we did give preferential treatment for the same reasons I just talked about. And we told other investors, and we would say that we actually identify them, but we don't have to, but we say these 3 do, but we're not gonna tell you terms, but they have preferential. So I don't view it as in and of itself a bad thing, and I don't view it as something that would cause me not to go into a fund. But I just would like to know, because of the following reason, especially now in my seat as sort of a smaller LP, right, an individual LP. Many fund managers, in their presentation to you, they're saying, oh, such and such is in. Well, then if you're going to say that, you're obligated to tell me if those terms are different, because, it's not just different fee structures. Sometimes, this is very rare, but sometimes the waterfall can be different, right? And that obviously may change the risk profile of what they get versus what I get. So if you're going to use it as part of your pitch, then I have a right, I feel, that I need to know if they have preferential terms, and that might have dictated why they're in. Doesn't mean it's bad, but I feel like I should know. That's kind of how I do it. And then I can make a decision or not of, not yes or no, but how much do I put on the fact that, oh, such and such, oh, Charmel's in, University of Miami's in, okay, I see. So he's in, he got smart money in, should I be in? Wait, Charmel's getting all this, okay, I don't know, man. He's got a different deal than me. So I need to know.
Yeah, no, thank you both for those. I think those are really valuable comments that I think people probably run into more often than they think. And I think disclosure is key, but I think kudos to you, Candice, for handling those discussions, and excited to hear more.
I have one more thing, Charles. Sorry.
Yeah, of course.
For everybody who's watching, since not all fund managers do disclose that, you should ask that question. Because when you ask it, they have to, I mean, obviously we're assuming everybody's honorable and all that stuff. They have to answer it honestly. So it's a question that I always ask.
Right. So I think you both touched on this prior in prior questions, track record. Candice, if I can start with you in terms of how you think about marketing track record, right? And whether it's are you highlighting the team from prior jobs, or and then I want to turn to you, Malcolm, for part B, and how do you think about verifying track records? And in this specific case for new funds. But Candice, I want to start with you with that question.
Certainly. So I'm an emerging fund manager. So let's just start by saying, I'm new here. And so for us, no matter what we say, we're a new fund manager, and whatever we've done in the past, people don't believe it, right? So it's like starting from scratch. But as we display our prior careers, so Brian talks about his work at Kairos, running a facial recognition company. He was at IBM, he's been at Comcast, he's talked about his career at Apple, and really his fundraising path with Kairos. So that's a lot of the work that he talks about. For me, I studied economics and statistics, was a consultant for about 15 years. And then about 4 years ago, I started an accelerator that was specifically focused on supporting women and minority-led tech companies. With that org, I had a micro fund. So very small fund, a little less than $1 million. And I made 8 investments out of that fund, 100K investments. And so that is the track record that we're able to share. I also share the companies that our investment committee passed on. So it was a 5-person investment committee. And we take really diligent notes, through committee. So every company that went through investment committee, we share who voted what, and then we followed the path of those individual companies. So it's pretty widely known that Playversus went through the due diligence process with the accelerator a few years ago. Some members of my investment committee said no, right? But that was my yes. So we track that yes over time, and that company's on track to be a unicorn, but we keep those notes. So that is what we've shown in our deal room, the companies that we've selected before. Now, I'll add to that, we had our first close in June, and we started making investments immediately because we wanted to show track record as it is occurring right now. So those 6 investments we now share so that people can understand our investment process and how it's in action today. So We'll make our 7th investment coming up soon. And we're now, kind of sharing all of those notes and investment memos with, current LPs and potential LPs to better explain track record.
Malcolm?
Yeah, I think I'd like to elaborate on that. I think this has been one of the big barriers that institutional LPs, it doesn't really matter to me if it's intentional or not, but it's a barrier for basically competition among the asset managers. Because I believe a track record can manifest itself in so many different ways. And I think having this single, oh, it's got to be 5 years, 10 years, you, the same team, exactly, wearing the same clothes in the same city, on the same leap year, blah, 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 blah. I mean, come on. The bottom line is, do you know what a good investment looks like or not? Can you source good investments or not? That really is what it gets down to. And that can manifest its way in so many different ways. So I really think, even though I went through that whole process, right? So I was in Candice's seat 20 plus years ago where we were raising money, and I had to go through that dance, and I was successful. And then I was on the other side of that where, the last fund I ran was over $3 billion. And we were getting, we had the benefit of, oh yeah, we have the track record of X number of years. Now, I was the same person. And at the end of the day, I don't think the track record later on was more or less indicative of who I was and what my capabilities are. So I really think, especially in the alternative investment space, there may be a bigger argument over on the liquid side, right? On the listed security side, but I can even push back on that. But absolutely on the alternative space, the fact that you may have worked at KKR or not, or worked in an accelerator, you're doing the exact same thing. You have to source deals. You have to make a determination, is it good or bad? And if it's good, then you say yes. And the fact that you can't, quote, claim that as a track record because you're at KKR and there's 100 other investment professionals doesn't, undo the fact that that really was your decision to invest in that company. So I actually am more liberal, I think, than other potential investors in allowing new managers to express their track record the way that Candice just said hers. I'm completely fine with what she just said. That, Brian did this, I did that, and you put it all together and say, okay, fine. Do they have the skill sets? Do I think it's that they most likely have the skill sets to do the key components that I think are needed? And I would say yes. So then the question is, okay, explain to me how you're going to use those skill sets and what processes and, how do you source? I understand you guys know how to source, but tell me how you're going to do it. And if I think, okay, they have the right type of network and the right type of sourcing mechanism to source, checks that box. And then I say, okay, fine. I get your background in consulting. I get his background being in startups. That should, so walk me through how you're going to make that decision making. You tell me what you think is a good company. Tell me the attributes, and I would dig in on that. And then I would say, okay, fine. I think that they have the ability to source and they have the ability to make the right decisions. Now, having said all that, I do think it does help to be able to show to some past success. So I'm not saying that it's not relevant. Did you have some good investments or not? I'm just saying the way that some institutional investors want it all sort of in a bow tie and starting exactly this day and be exactly 10 years. And if it's only 8 years, you don't qualify. I think it's completely ridiculous. But it doesn't negate the fact that having some form of track record is helpful. But like I said, that can manifest itself in a way of, like she just pointed out, some notes you took that you said, you know what, this validates my decision-making process. So I would encourage all aspiring fund managers that you can create your own track record by being diligent, even if you're being an angel investor. I think what Candice said is a fantastic idea. Just keep track of everything you looked at, right? And then, because you usually get emails, you get the investor deck. So you can have your own, even as an angel, you can say, okay, these are all the deals I looked at. And these are all the ones I said no to, and these are the ones I said yes to. And these are the ones I said yes to and didn't get in because I was too small, but at least I had this email saying I want to be in. And these are the ones I actually got in. So you can create a track record, even if you're not a fund manager, even if you don't have a lot of money, because it's not the amount of money you invested, it's the proportionality of how many times you had good judgment versus bad judgment. And it's the quantum of how well the good judgment did, i.e. was it twice your money? Did it go up 10 times your money? Did it go up 100 times your money? So that to me is really what a track record's about. So I have a little bit of an unorthodox view of that. And the last part of your question about how do I validate it? I mean, I just ask a lot of questions. I really drill into and want to understand their logic. And then I would want to see some examples, right? As to their track record that they're putting together that might be a bit unorthodox, and just walk me through each investment. Just walk me through it. When did it happen? What was the logic? Why did you do the the double down, the reinvest? How come you didn't double down on this one? You double down on that one. And over a couple of meetings of asking those kind of questions, you should have a pretty good feel as to, do you believe that they're going to be able to invest in companies in a thoughtful way going forward?
Thank you. That was really insightful by you both. That was awesome. I want to turn to one of the bigger differences in my mind about investing in an individual company versus a fund. That's fees. So if you've been an angel investor, now you have this management fee and this carry fee. What is this thing? Candice, can I throw it to you to maybe talk about maybe from your experience as a new fund owner, sort of how you think about the fee structure, what in your research and diligence has been sort of a market fee structure would be helpful, I think, for the audience.
Yeah, I mean, we have a fairly typical, kind of like, well, actually we're 2.5% management fee. We know that this particular group of people that we work with require just a little bit more work. So we have a slightly higher management fee at 2.5%, but beyond that, it's fairly standard. And it declines over time. So we were going with what we felt was standard in the market. And that just comes from, listening to our mentors. Anything outside of that realm, I think that it wouldn't have been palatable. We can't be that different than our majority peers as Black GPs. And so we were going for what looked familiar to the LPs that are in the fund currently.
And no, coming to you, Malcolm. I want to hear your view on it, but
Sorry, go ahead.
For the people who may not know sort of the structure, so you mentioned sort of the second part, which is the carry, is more standard and steps down over time. Can you be a little bit more explicit? If
the management fee steps down over time, but it's an 80-20 fund, so 80% goes to the LPs, 20% to the GPs, with a 2.5% management fee that steps down over time.
Got it. Great. Thanks. Malcolm, do you have some comments on the
fee? Again, I've been on both sides, where I've been a professional money manager and got the benefit of the fees, and now I'm on the other side as an LP paying the fees. So I guess what I would say is, Candice said it, but let me really emphasize it. As a new fund manager, it is paramount that you know what is market on what is normal in fees. You absolutely need to know that. And you can get it from mentors, you can get it usually from advisors like lawyers, and whoever else is helping you raise the money. Because one of the things that really can turn off LPs is, it's not just when you ask for more fees, it's just the fact that you don't even know you're asking for more fees. So it really shows that it's rookie time. So to me, you really need to know what is market, first of all. And then once you know what's market is, I agree that you should be within market. So on management fees for a VC fund, that's relatively small, 2 to 2.5% is market. And on the upside, it's going to be 20 to 25%. I personally think that you should be going, you should not be on the extreme of those, definitely not on both, right? So I think it's perfectly okay for a smaller fund to say, oh, we need 2.25, 2.5%, because there is a certain amount of resources they need. So you as an investor don't want to shoot yourself in the foot and say, no, no, you can't have those resources, i.e. lower management fee, and then they can't properly manage the fund, right? Because they don't have the resources. But on the other hand, you want to make sure that the management fees on bigger funds are not so big that they don't even care about the carry, because that's really where you have the alignment of interest is in the carry. Now, the one thing that I also like to look into, and I think I'm probably unique, especially as it comes to individual investors in these funds, is the expenses. Like, to me, I have no problem with the management fees and all that. What I don't like is a gazillion expenses that are charged to the fund, especially the expenses that I thought the management fee was supposed to be paying for, right?
Can you give us some examples of those expenses?
I'm sorry?
Can you give us some example of those expenses that
Well, like for instance, you know, third-party expenses. So if you have any consultants, if you have any specialists, that's fine. The problem is where that line is drawn, right? So what I've seen is some funds, and I definitely don't invest in these funds, where they charge a management fee and they're saying, oh, we need the management fee to obviously hire people to do due diligence. Yes, of course. But then it turns out that they've almost outsourced all their due diligence, and that due diligence expense to that third-party expert is charged to the fund. So what was the point of the management fee? I've seen that. I've also seen double layers of fees where that same group is charging another set of fees to that fund for other services. I'd rather just say, you know what, here's the management fee. You make sure you have enough. You know what you need to do. You know, sometimes some funds charge travel expenses to the fund, and sometimes that's management fee. You know, maybe the things have changed, but when I was a professional money manager, we always paid for our own travel out of the management fee. So those are the kind of things. Now, again, it's usually not in and of itself a reason for me not to invest in a fund or not, but it's to me one of those like smell test things. You know what I mean? Where it's like, you know what? I'm out. It's just, you guys clearly have a different agenda. Like, I want to pay you fees to have enough money, to have enough team to do your job. And I want to incentivize you with the carried interest, with, you know, sharing the profits so that we are aligned. I have no problem with that. But when you start nickel and diming everything on the charging the fund, it's like, okay, maybe you're in this for the wrong reason. Definitely I'm out. So I have backed away from funds because, in my view, they're nickel and diming at the fund level expenses. And it wasn't in and of itself like so egregious, but it was just, to me, it was part of my due diligence of the mindset. Like, then is it because you don't have the confidence that you're able to pick the right type of companies and therefore there's gonna be a lot of profits and assuring the carried interest? Because to me, that's a huge part of them putting, quote, skin in the game, right? Which we haven't talked about yet. Usually as the GP of a fund, you have to put in a certain amount into the fund. Now, my view on that is it just is predicated on how much money you have if you can't afford to put up 1%, because usually 1% is a minimum. So if it's a $100 million fund, not everybody has $1 million, I get that. But if you put up $50,000 and that's a lot of money to you, that's good for me. It just needs to be significant to you. So that's one thing. And then the other thing is, I need to believe that you're good. And you can say all you want that you're good, but it really shows up in you believing in that there's upside in your investments. Therefore, that you're going to get some of the carried interest. And that's why you're in this. And the reason why I'm bringing this up is if you're getting so many nickel and dime fees, maybe you're not really counting on getting that upside, and that's why you're doing this. And therefore, if you don't have the confidence in yourself, then I certainly don't.
No, thank you for that. And I think this is an important point for the audience, you know, who may in the past have just been angel investors in individual companies. Is this concept of management fee, right, which is essentially going to be charged on an ongoing basis. That's basically keeping the lights on fee, right, for running the fund, hiring people, so on and so forth. And then this carried interest portion where the fund gets 20% in general of the upside, and then you as an investor in the LP keep the 80%. Again, I think that's something that is definitely different and unique from investing in individual companies. So thank you both for your insights. You know, Candice, I want to go back to you about the concept of investment periods. So we've been talking a little bit about fund terms, whether it's fees, things like that. You know, when you were thinking about an investment period for your fund and the overall length of the fund, how did you guys think about that when coming up with the terms?
Yeah, so it's a 10-year fund. So it really went back to going back to our mentors, understanding what was standard. And Malcolm, I'd love to hear your opinion on some of this. Standard and market is not the same everywhere in the country.
Right.
And so building a fund in the Midwest, but having LPs that are sometimes from the coast has been an interesting process. We started with attorneys that are in the Midwest and now have attorneys that are in Florida. So we've got this like very strange and interesting mix of what's market and what's not. You know, we're investing, you know, really over time, but really strongly focused in the first 3 years. And what we understand, that's market. We'll make investments in 35 companies and then have a reserve follow-on as well. So we were going for what we felt was market in our region, and really just talked to lots of people about that process. But I'd love to hear from you, Malcolm, about that and what's standard and market other places.
Yeah, I think there's a bias on the coast to have a shorter investment period than a longer investment period. I think for two reasons. One is, you know, the math of management fees of not putting money to work, I'll use a term, but J-curve, right, effect, where you're having, you know, remember to the audience, you know, a 2% management fee in of itself is not that big, but let's say it's a $100 million fund, so that's $2 million per year, and that comes from the fund. Now, let's say you've only invested $5 million in the first year. So it's $2 million of fees versus $5 million in investments. So relative to what you invested in, it's quite substantial, right? And over time, obviously, as you invest more money, the denominator of what you've invested gets closer and closer to the full size of the fund. And therefore it starts to not look as that bad. But in the early years, if you take a long time to invest, that J-curve effect can be quite big. So I think to some extent, some of that's driving it, Candice, is that. And then the other thing is, quite frankly, you know, I have a view of some of the West Coast funds as being a bit cavalier as it relates, none of the ones I know, none of the ones I invest in. So I'm not talking about anybody, I'm talking about the other people, the ones I've not invested in. I believe that they have a cavalier attitude towards, what's the point of due diligence? I kid you not. That it's like, you know what, I have a meeting with them, I can tell you if they're good or bad, and blah, 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 and here's the check or not. And what's the point of doing all this deep due diligence? So I think that's sort of the norm on the, you know, specifically in Silicon Valley. And therefore they believe that, like, they really believe that. And because of that, you know, there's so much deal flow, and, you know, no place else in the world, like, our meetings 15 minutes long. Right? I mean, just think about that. That's just sort of crazy. Like, how are you going to determine anything in 15 minutes? But they believe that they can in 15 minutes determine at least that first cut. And I believe some people can, but I think most of the time, you know, you already had a bias going into the meeting. That's really what I think, is you already had your mind made up and you're just confirming it. That's a different statement than saying, I have an open mind and I'll determine after 15 minutes, will I go to the next step or not? And I'm only raising that because we all know what that means is it's usually to the detriment of founders of color that they've kind of gone in with a bias against it, unless there's like, you know, I'm folding my arms here to make a point, you know, go ahead, make your point in 15 minutes, prove me wrong. And that's just not going to happen. But the bigger issue here is there's that cadence on the West Coast of, yeah, I know it's a good deal, it's a good deal, it's a good deal. Oh, there's tons of deals out there. Oh, we're in the center of the universe, we see everything. So if you believe all that, then why would it take you 3 years to put the money to work, 4 years to put the money to work? Is something wrong with you, or is there not enough deal flow? What's going on here? So the mentality is that you should be able to put the money to work in a 1 or 2 year period and do it correctly. And therefore a investment period of 3, 4, 5 years, hey, maybe that's a signal of, you know, you don't have a deal flow, or maybe it's a signal of there's not enough good companies in the Midwest. I'm just saying that what might be signaling, right? And therefore a longer investment period may not be viewed as positive. But from my perspective, you know, I like people to do due diligence. I like the fact that they don't say yes to everything that comes right in front of them. So I have sort of a different view, but some people on the coast do like shorter, like if you take a long time, they may come to the conclusion that maybe we need to cut back the amount of money that you have. So if you're telling me a 15, I'm not saying this on green, I'm just saying what they might be thinking. If they may be thinking, oh, if it's going to take you 4 years to put out 50 million, then maybe you should only have 25 million and get through 2 years and come back to me for the next fund and do it that way. So that might be what's sort of driving that. If people think that the time of investment period is 3 or 4 years is too long.
Do you think that that thought process will be an issue, like kind of during times like this, like so during COVID? So making those investments all within a year or two, and maybe this vintage won't work out well. Do you think that could be an issue? But like just that general thought process?
Yeah, I don't agree.
Oh no, I don't think you agree. I don't think you agree.
But yes, and that's precisely why I think you have this up and down. It's almost like wine. Oh, well, it rained a lot that year and this wine sucks. Well, okay, then why don't we have something that we don't have to harvest all in 1 year? Right, but you know, I just think that at the end of the day, unfortunately, you're dealing with huge perceptions. Perception one is that Silicon Valley is always right, in spite of their 99.99% failure rate if your definition of success is unicorn, or a 90% failure rate if your definition of success is just a $50 million liquidity event, which is actually pretty terrible, 90% failure rate. But that's Silicon Valley. But it's a very confident, so we say environment in Silicon Valley, and they think that they have it right because Uber exists and Facebook exists and they participate in that. Don't look behind the curtain and all the dead bodies and all that. But the bottom line is that's the starting point, and that's the perception. and there is tremendous deal flow in Silicon Valley. Okay, so that's the starting point of an LP who's talked to a lot of Silicon Valley investors. And if that LP believes that that is the benchmark that is correct, that's what you're dealing with. Now, I'm not saying you have to mimic it, but at least you have to know that that's what they're starting with. And you have to explain why you're different and why it's not indicative of you not having a good opportunity set and all those kind of things.
Yeah.
Right?
You guys are making my job as moderator really easy because you know, I want to make sure I leave some time for questions because we're getting close to 6:15. But I'd be remiss if I didn't ask one COVID-related question. And Candice, you touched on it in terms of, how do you roll out, new investments in this time period? And I was reading an article where you and Brian had an unconventional diligence method, which sometimes to live with the founder for a week, rent a house. How are you thinking about diligencing new investments in this COVID timeframe?
Certainly. So that's from some of our nonprofit work. So we run also Hillman Accelerator and New Me Boot Camp. So New Me started back in 2012 under the tutelage of Angela Benton out in San Francisco. And she started a program where for 3 months, she lived in a house with up to 10 founders, and they were getting to know Silicon Valley. She then moved it to Miami a few years ago, and we acquired the brand last year. And it was, 10 people living in a house going through boot camp programming. What we realized was there was some great deal flow there. And there were people flying in from everywhere. And so it really happened in reverse order. It started as educational programming, and then we realized, we're spending a week with these people. We really know them well. Their company is super dope. We're getting great applications. We're going to start to harvest from this particular group. So we've made some modifications to the program. We'll roll it out in a hotel style format next spring. We have a few cities that we'll roll out to, so Detroit and Tulsa, Oklahoma, and Cleveland, Toledo, Cincinnati, and Indianapolis. So that's one way we're kind of still dealing with kind of diligencing things. But on the kind of pipeline issue, we run a program called Twitch Pitch every Tuesday and Thursday night on Twitch, where we look for more exciting companies, and that's how we are now currently filling the funnel. So we see over 1,000 applications every year. Last year we saw 2,000, but this year we're at about 1,500. So maybe we'll round the year off at about 2,000, but we see lots of great deals. And I think it's important to know your founders well, break bread with them. We have made investments over Zoom, but I think it's also important to know the founder really well before you make an investment.
Malcolm, how do you feel about doing diligence via Zoom, never having met the founders?
Well, first of all, after that story, I'm gonna go get my sleeping bag out of the trunk. And
Come through. We're always looking for mentors. Come on over.
no, but I want to give a shout out to Candice. I think that's a great idea. I think that's a fabulous way, because at the end of the day, I think you are going to have tremendous insights into that founder, without a doubt. The only question, of course, is how scalable is it, right? To do a whole thing. But I think, to our point though, I think even if you cut it down to like a night or two, as opposed to 7 nights, because after the 7 nights, I get the hell out. But if it's just 1 or 2 nights, I still think that's a great way of getting to know, really, how they operate, what their ethos is and all that. So that's a great idea. So kudos. But in terms of Zoom, absent what she just said, meaning, let's say you just do a quote normal meeting, as opposed to spending the whole week with them, I personally don't see as much as a difference. Again, I want to make this very clear. If it was the difference between me having a meeting face-to-face, and that's all it is, just a meeting face-to-face, versus a Zoom, I don't think there's, from my perspective, I invest in Asia, I've done so many calls overseas for decades, that doesn't faze me at all. But if you're comparing it to spending out of the meeting time with them, that's different. Okay, so that I think is valuable. So if your process was, we would meet and then we would go spend some time together, either have dinner or whatever, have drinks, that I think is invaluable to better understand the founders, but not everybody does that. So I'm just saying, if it was just strictly a face-to-face meeting and it's 15 minutes or 30 minutes or an hour, and then they leave, I think doing Zoom is just the same thing as meeting them. Or 95%, so close enough.
Awesome. Well, thank you both. Again, I want to keep us on time as best as I can. So I think we have time for a couple of questions. So the first one I'm going to start off with is this is for you, Candice. As an emerging manager, are you planning to raise an institutional fund?
As an institutional fund. So I think I need some elaboration on that particular question, but I'll say who we're raising, like the types of LPs we're raising from.
Yeah,
So when we first decided to raise a $20 million fund, we set a $100,000 minimum, because if I look at the capital path for emerging fund managers, they're typically kind of like grabbing that money hand over fist from ultra high net worth individuals. So we thought we were going to have 1,000 meetings with some really wealthy people. That wasn't necessarily the case for us. So less than 25% of the fund are ultra high net worth. Most are institutional investors. So we have some institutional investors, some government entities, foundations, ultra high net worths, and corporations. So it's a pretty wide array of LPs for us.
I think that's super helpful. And I think that may not be the norm, Candice, just as you know. So that's pretty amazing that you have such a diversified pool of LPs as a first-time manager. So kudos to you, Malcolm. I think you mentioned this, but just going back to the management expenses. Somebody asked, or Candice as well, can you give an example of an expense that you believe should be charged to the fund? In their opinion, all expenses should be.
Yeah. So audits, definitely, the financial statements, anything you're preparing the K1s, any doing NAV calculations. So all the things that are necessary to do that, it's pretty market that those type of activities are charged to the fund, and there's some more that I just can't think off the top of my head. So I want to make sure everybody understands. I wasn't trying to say that, oh God, there's 5 expenses to charge a fund, don't do it. There's a standard list, but there's also other ones when people start to nickel and dime. To me, the one that, and I already mentioned, is the whole due diligence thing. Like either you're going to do the work yourself or you're not. And if you're just going to rely on a whole bunch of outside consultants, then what are we paying you for?
Yeah, I find that to be incredibly interesting that folks are outsourcing due diligence. That would make me nervous as a general partner. And how do you answer to someone else's due diligence? Yeah,
nobody actually says they're going to do it that way. They just have that line in there, and then you say, okay, well, what's that for? And then they say, oh, well, there's some experts. And that is true. There are some industries that you would want an expert helping you go along. That could be like a bioscience, such an so I'm not saying that in of itself is bad, but when, I won't give the name of the fund, but when I did go in and ask more questions, and they were not willing, see, okay, here's a way to suss it out. Ask for a cap. That's what I did. So, okay, fine. That's completely reasonable. I was a fund manager. I used to have some experts, not that often, but every once in a while, you're looking at something, it's like, well, you know what, we need an expert on this. But that number should be really, really small.
And what do you think the cap should be relative to the fund size?
Yeah, it's usually a cap to the fund size.
Okay.
And that's, obviously it depends on how big the fund is. But, something that, because again, I've been a fund manager, so I have the hat on of a fund manager, and I know that sometimes you need that flexibility. So when I do it, I usually propose a number that I know that if they're really doing their due diligence themselves, but every once in a while they need, that they clearly have enough room. But I also have it low enough that they're actually planning or outsourcing a lot, that it's not enough. That's my trigger. And this group insisted on not having that cap. And I'm like, okay, it's tell me a scenario where the cap I proposed was not going to allow you to have, specific experts, then there's got to be something else going on here.
Okay.
Because having an outside expert in and of itself is okay. It's just the frequency. And it's like you said, I mean, there's a concept, as you know, called agency risk, right? You were a consultant, So agency risk means you're getting a third party to do something, but they have no skin in the game. So it actually is, let's just pretend that a management fee was actually directly reduced by the amount of outsourcing. So let's say it's a non-economic issue. Let me say that one more time. Let's say there was a 2.5% management fee. But let's just say that you were going to have a third party do due diligence and it costs $100,000. So in this example, you reduce the 2.5% management fee by $100,000. I'm not saying to do that, I'm just trying to make a point. Let's just pretend that was how you did it. So therefore the LP was indifferent from a monetary perspective. My point is, I still would not want to give money to a fund that is outsourcing most of its due diligence, even if economically it was the same, for the reason of what's called agency risk. Because you're outsourcing the due diligence, which is going to inform the decision maker of yes or no. And that outsourcing is to a party that is a transaction. They don't care or not. I mean, they're professional, but still they're not going to have the intensity because they don't own that track record, right? They don't have any skin in the game. They don't have the reputation in the game. They don't have any of that. Remember I said that he sometimes puts money into the fund. They don't have that in the game. So I absolutely will not invest in a fund, even if economically it's the same, in a group that outsources the majority of their work because of that agency risk. And I have used consultants, I have used outsiders. And usually when I do that, I have to have my team go deeper in it, make it better, because it's just not the same intensity. So it's not just this unfounded bias I have. I've had consultants all over the world work with me when I was managing, billion-dollar funds. And inevitably, that always happens. You have that agency issue. And you can manage that if you have your own team and they can review what the consultant brings to you. But if you're pretty much set up to rely on the consultant's view, and therefore it's going to overwhelm your small team, they're not going to be able to really dig in and push that consultant to give you the right amount of work you have. So to me, I absolutely would not invest in a fund that is overly reliant on outside due diligence. Some is okay, but a lot is not to me.
Thank you both for that. I think we have time for one more question because we started about 5 minutes late, and I think it's an important question. And the question is, as an angel investor, how do I become an LP in funds like Lightship or some of the funds that Malcolm's already invested in? What are things like the minimum? Candice, I think you already mentioned the 100K minimum for, when you guys started. And the last one, how do I get access? So maybe Malcolm, can you start off with what sort of how you've gotten access to them, starting maybe as an angel investor and getting access to some funds?
Well, I would just say that, and all minimums can be negotiated.
Yep, that's right.
So I'm not
Come through.
but I'm saying, in general, minimums can be negotiated, all right? So they tend to be there to get everybody to focus on, don't go below that. But for instance, you can always make yourself a value add LP, right? So I always try to do that, whoever I'm working with. I used to invest a lot in Asia. I've invested in a lot of different industries. So I try to make the case of, okay, this is why I'm value add to the extent I would need to go below the minimum, right? So just recognize that a minimum is what it is. It's on paper, and the GP always has the ability to waive that minimum, and it's up to them. And, now the only thing I'd be careful about is if they've waived the minimum for everybody and there's a gazillion people in it who's given like $10, then it might be indicative of the fact that they're not able to convince anybody to really put a lot of money in, right? Now, that's an extreme case. So just because somebody does go below the minimum from here and there, time to time, that's not a red flag at all. And that's fine. They're being flexible, and being a first-time fund manager can be tough. I was one at some point, and you got to do what you got to do. But even for a more established fund manager, let's say in Candice's second fund, for those who are out there who might have an industry expertise that they might want to tap into in terms of due diligence, that's value add. Maybe you have a platform where you can help with deal flow, that's value add. Or you might have a platform where you yourself know some other wealthy people or have a lead into some institutional LPs. All those are value add that even a second time or third time fund manager may be willing to go through their minimums because you're bringing value to the table.
Yeah, I'll add to that. When you're getting into, really any type of investing, I think it's just important to find a mentor. So find someone who has done that before, better understand like how you can educate yourself around investing in funds. I know for myself, anyone in my network that's interested in investing, I send them to Angel 101 through Angel Capital Association. So go through the process, better understand how to read the docs, take some practice reps, maybe, it's almost like the stock exchange game, right? So, learn about what you would do and then track your record over time before you put in tons of money. But I think it's all about educating yourself and figuring out, what your own risk tolerance is, understanding, how long your money is going to be locked up. I think it's all about education before you start writing checks into funds.
And Charmel, isn't there a group in Miami that focuses on Black Angels? What was the name of it?
This one, I think it's called Black Angels Miami.
Oh, that one.
that one that just
Join Black Angels Miami.
together syndicates and
That's where we'll go. That's where I'll send them.
exactly, and that's actually a great segue. To next week. Don't forget to tune in to Black Angels Miami. We have fun pitch night next Tuesday at 5 p.m. But I think we're out of time. Candice, Malcolm, I want to thank you guys so much. I think this has been extremely insightful for people who are maybe angel investors but haven't invested in funds, and just some different things to be thinking about. And like I said, next Tuesday, come please and listen to Candice put all this stuff to action. She'll be talking to our membership about a potential investment. So if you want to access, as she said, come through. We'd love to have everyone. And thanks again, Malcolm and Candice. This has been great. Have a great evening, everyone.
Thank you.
Yeah.
Bye. Bye.